Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Philip Palumbo, founder, CEO, and CIO of Palumbo Wealth Management, for a macro review of conditions in 2021. Philip, it's great to meet with you. Welcome to Trade Talks.
Thanks for having me, Jill.
And as we saw in February, stocks are sensitive due to rising inflation. What does that mean for rates? What's your outlook for economic growth this year?
So the way we connect the dots here is we look at and understand there's four economic environments. It's either inflation's accelerating or inflation's decelerating, either growth is accelerating or growth is decelerating. So right now we believe today and going forward that we're going to be in an inflation accelerating and a growth accelerating environment. Typically, I always say that history doesn't repeat, but oftentimes it rhymes. So if you look at this recent playbook, right before the crisis, before COVID happened, interest rates hit a peak, and then during the recession, it troughed. And now as we start to move out of the recession, you start to see the 10-year Treasury creep up again. So that's perfectly normal and what happens when you go through a recovery. The question is, and nobody has a definitive answer, is how high is the 10-year or the long end going to really go? And that's something that we're watching very closely.
Right. And of course, with inflation, you have to start to question what the Fed is going to do with rates. And it appears that the bond market is kind of pricing in more demand than Fed inflation data is suggesting. So do you ultimately expect rates to rise or remain the same, and why?
Well, we have to first understand why interest rates would rise. So like I said before, interest rates will rise because we'll continue to recover from this economic trough that happened back in March 23rd. The Federal Reserve understands that if the 10-year or the long end continues to move a lot higher from here, that's going to impede economic growth, and that's something that the Fed doesn't want. Plus, all the interest that the Fed pays with our budget, that could be an issue as well. So the Fed wants to do all they can for interest rate to go up and normalize. That's probably important to them, but at the same time, they want to try to do all they can to pressure rates down to not impede economic growth. So that's really important, and that's really important for all of us to understand as investors. So I believe the Fed will step in if they need to step in.
And commodities have performed well, particularly crude and copper. Are they entering a bull market?
We actually do believe they are entering a bull market, and there's a couple reasons why. Number one is all the pent-up demand that we believe we're going to see the back end of this year and going into 22 because of everybody getting inoculated and creating herd immunity. That's going to open the floodgates for people wanting to go out there and spend money. So that's number one. And number two is when all the fiscal stimulus that we saw and will continue to see, money goes to the consumers' pockets, which means when, again, the floodgates open up and less restrictions, consumers are going to go back out there and spend. All of that demand is going to put constraints on supply. In addition to that, which is really important, which we're really studying, is a possible infrastructure spend bill. So if that comes to the table, just that announcement alone will continue to see commodities do well over time. And then one last point is, if we're going to go into an environmental, climate-friendly environment, you're going to see, in order to create that, you're going to need commodities to create that type of environment. So all of these reasons, when you put it all together, we believe you can see a secular bull market in commodities.
Yeah, those are all great points. So Philip, the question is, what's it going to take to get the market to the next level? Because you have to justify the multiples that we're at some point.
Correct. So, and that's a challenging thing right now. The PE multiple today trading at forward 26 times historically is high, and 22 times. The high back in 2000 was around 26 times. So last year was multiple expansion due to the Fed stepping in. This year, there is no doubt investors are really laser focused on earnings and what we can produce as we think about 21 and even go into 22. So based on where earnings are, which most people are forecasting to be greater than 2019, so if you apply a reasonable multiple of 18 to 22 times to an earnings print number that could be greater than 2019, I don't see a significant upside to here in terms of performance relative to what we saw in 2019 and 2020. So I do think markets today have front run the recovery in the market, due to COVID, which means that I think the market's ahead of itself from a multiple standpoint. So that's the challenging point, and I've been pretty vocal about that. So I wouldn't be surprised if we see volatility, if we see markets retract a bit from here, just to correct itself based on where multiples are today.
And finally, what sectors of the market do you prefer, and what are some recent buys on the recovery thesis have you made?
So investors are whether you're whatever network station you're watching, everybody's hearing about this cyclical recovery, being cyclical stocks, et cetera. The reason why we're all saying that is because when you hit a trough in the economy like we did last year, and you start to recover like we did this year, and forward anticipation of economic growth accelerating, cyclicals are the place to be, because cyclicals are cyclical, meaning that when economies recover, you typically see people going out and consumers buying more cars, traveling more, getting on an airplane, going out to restaurants, and doing things that consumers typically do when you have an economy that is increasing. So sectors like airlines and restaurants and hotels and energy, financials are areas that are cyclical that you want to be in as you start to recover.
All right. Appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill, for having me.